Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts and strategies that can help you succeed. Today, we're going to talk about cost volume profit analysis, a powerful tool that can help you make informed decisions about your business. So, what is cost volume profit analysis? In simple terms, it's a way to understand how the costs and revenues of your business are related and how changes in these factors can affect your profit. It's a crucial concept for any business owner or entrepreneur to grasp, as it can help you identify areas where you can cut costs, increase efficiency, and ultimately boost your bottom line. The origins of cost volume profit analysis date back to the early 20th century, when economists began to study the relationship between costs, volume, and profit. Over time, this concept has evolved to become a key component of business strategy and decision-making. Today, it's used by companies of all sizes to inform their pricing strategies, manage their costs, and optimize their operations. So how does cost volume profit analysis work? At its core, it involves analyzing the relationship between three key variables: cost, volume, and profit. Cost refers to the expenses incurred by your business, such as labor, materials, and overhead. Volume refers to the quantity of goods or services you produce and sell. And profit, of course, is the difference between your revenue and your costs. To apply cost volume profit analysis, you need to understand the different types of costs involved in your business. These include fixed costs, which remain the same even if you produce more or less, such as rent or salaries; variable costs, which change with the level of production, such as materials or labor; and semi-variable costs, which have both fixed and variable components. Let's consider a real-world example to illustrate how cost-volume profit analysis works. Suppose you're the owner of a small bakery that produces and sells cupcakes. Your fixed costs include rent, equipment, and salaries, which total $1,000 per month. Your variable costs include ingredients, packaging, and labor, which total $2 per cupcake. If you sell each cupcake for $3, your contribution margin is $1 per cupcake. Using cost-volume profit analysis, you can calculate your break-even point, which is the number of cupcakes you need to sell to cover your fixed costs. In this case, it's 1,000 cupcakes per month. You can also use this analysis to determine how changes in your costs or pricing will affect your profit. For example, if you increase your price to $3.5 per cupcake, your contribution margin increases to $1.5 per cupcake, and your break-even point decreases. Another example of cost-volume profit analysis in action is the story of Southwest Airlines. In the 1970s, the company was struggling to compete with larger airlines, and it needed to find a way to reduce its costs and increase efficiency. By applying cost-volume profit analysis, Southwest identified areas where it could cut costs, such as by reducing the number of flights and focusing on shorter routes. The company also implemented a variable pricing strategy, which allowed it to adjust its prices based on demand. Today, Southwest Airlines is one of the most successful airlines in the world, with a strong brand and a loyal customer base. Its success is a testament to the power of cost-volume profit analysis and demonstrates how this concept can be applied in real-world business scenarios. So, how can you apply cost-volume profit analysis in your own business or career? The first step is to have a solid understanding of your costs, both fixed and variable. This will help you identify areas where you can cut back or optimize resources. Second, make sure you're tracking your sales volume and revenue accurately, so you can see how changes in these variables affect your profit. One tool that can help with cost-volume profit analysis is a simple spreadsheet or accounting software. These tools allow you to model different scenarios and see how changes in costs, volume, or prices will impact your bottom line. My colleagues on Wall Street swear by these tools, and I highly recommend them for any business owner or entrepreneur. Another strategy for success is to focus on reducing your variable costs, such as labor or raw materials. By streamlining your operations and improving efficiency, you can reduce your cost per unit and increase your profit margin. Additionally, consider using data analytics and machine learning to optimize your pricing and inventory management. Finally, remember that cost-volume profit analysis is not a one-time exercise. It's an ongoing process that requires continuous monitoring and adjustment. As your business grows and evolves, your costs and revenues will change, and you'll need to adapt your strategy accordingly. By staying on top of these changes and making adjustments as needed, you can use cost-volume profit analysis to drive long-term success and profitability. In conclusion, cost-volume profit analysis is a powerful tool that can help you make informed decisions about your business. By understanding the relationship between costs, volume, and profit, you can identify areas where you can cut costs, increase efficiency, and ultimately boost your bottom line. Whether you're a seasoned entrepreneur or just starting out, this concept is essential for success in today's competitive business environment. If you have any questions or topics you'd like to discuss, please don't hesitate to reach out. Like, share, and subscribe. And remember, every great business starts with action. Make your next move count.